The Lazy Investor by Derek Foster. This book gives off the idea of starting with $50 and no investment knowledge for complete beginners. Chapter 2. Only invest in fund companies by owning shares because regardless of rate of return there are still management fees regardless of outperformance/underperformance or losses, page 14. Best way to invest is by opening up a discount brokerage account and buy quality, recession-proof stocks and simply sit and collect the dividends, page 15. Stock market, pages 16 and 17, here are some key terms to consider. Bull market, when prices are moving higher. Bear market, prices are moving down. Mutual funds lose 40% of what your projected earnings are because of commission fees. Better to own stock of a bank than invest in it, page 29. For example, for the company Scotiabank, if you invested in 1989 you would have earned 36% every year on your original investment, page 29. A 2-for-1 split or stock dividend is having 2 shares for every 1 share you originally owned, so if you had 1 share worth $100 and the stock splits 2 for 1, you now have 2 shares worth $50, page 30. Scotiabank has paid dividends for longer than anyone in Canada since 1833, page 32. If your grandfather bought 10 shares in 1944, the stock has split 10 times since then, and the total would have grown to 12,000 shares, pages 31 to 32. Chapter 5. DRIPs and SPPs. DRIPs is a term that stands for Dividend Reinvestment Plans. For example, 2 twin brothers at 20 years old buy 100 shares of a company. Shares cost $50 each, so a $5,000 total investment. Let's assume the company returns 12% per year to shareholders over the long term, 8% by way of capital appreciation, increase in share price, and 4% from dividends. First brother keeps his shares but spends his dividends at age 65. His original investment, $5,000, turns into $160,000. Second brother enrolled in the DRIP and systematically reinvested all his dividends. At 65, his investment turns into $820,000, 5 times as much as his brother. Total money at retirement becomes 5 times greater when dividends are reinvested. These dividends only represent a third of the percentage rate of return. For example, if the father bought 100 shares 10 years earlier at 65, those shares would amount to $2.55 million, page 48. The DRIP concept is mechanical in nature since dividends get reinvested automatically at regular intervals. Therefore, you benefit from dollar cost averaging, which will actually outperform most investors. This strategy ensures that you buy more shares when the price is low and fewer shares when the price is high. By investing in DRIPs, you benefit when markets crash.